Bene, buon pomeriggio.
Good afternoon, and thank you very much for being here. My name is Dino Pesole. I am a journalist for the Italian financial daily newspaper Il Sole 24 Ore, and it is a pleasure for me to introduce today's debate with Professor Brunnermeier on a topic which is very important today and very much online with the leitmotif of our festival, that is soaring relinquishment beyond the monetary policy. In my introduction, I would like to stress the very close relationship between financial stability and fiscal policy measures. This has become particularly relevant for the Eurozone crisis and for the international debate about the need for a higher degree of coordination to tackle systemic crises and to prevent them. A coordination between balance and budget decisions related to monetary policy and price stability. These are three elements which we sometimes tend to keep separate one from the other in our analysis, but really they're strictly connected one with the other. So just a few hints to introduce the discussion, referring to what has happened in Italy in the last 2 years. As our President of the Cabinet, Mr. Letta, was recalling yesterday, there have been 28 international summits with heads of state and prime ministers who have tried to tackle a crisis that has frontally attacked Europe and the world in a totally unexpected way, posing significant issues in terms of market regulation and budget policies. As our Prime Minister, Mr. Letta, recalled, the turnaround was not due to an economic policy decision or a fiscal policy decision, but rather the turnaround was due to a decision made by Mr. Draghi, President of the Central Bank, and rather, this was an announcement of the decision when, back in August 2012, President Draghi paved the way to so-called unconventional operations, i.e. buying bonds from risk countries on the secondary sovereign bond market. And at that moment, the spread decreased, and anxiety decreased as well in relation to the different instruments we have to tackle systemic crisis, giving birth in Europe to important instruments such as the two safety funds, the temporary and the permanent one, and this is one of the topics I would like to attract Professor Brunnermeier's attention onto, the launch in Europe of a project for a real banking union monitored by the European Central Bank. So these are the topics that will be addressed by the European Summit on the 27th and 28th of June. To shift the attention now towards the rest of the world, I would like to say that worldwide there is the need for a high degree of integration. Integration between the decisions made by central banks and the decisions made by fiscal bodies. In the United States, ever since Lehman Brothers went bankruptcy, there has been a lively debate on instruments to prevent the collapse of banks. And in Europe, there has been a very important impact and many countries had to increase their public debt to support and bail out banks. So integration is something fundamental. It is necessary. And as an observer, to be honest, I haven't seen one single direction, either as far as Europe and as far as the world is concerned, that indicates the way to go. That is, how will economic policy decisions interact with monetary policy decisions, as well as decisions on the stability of the financial system. Professor Brunnermeier is a well-known expert in these topics. He has researched specifically financial markets and macroeconomics, with special attention to liquidity, financial bubbles, financial stability, and the way how all these factors can affect the ruling of financial markets and monetary policy. So without further ado, I would like to leave the floor to Professor Brunnermeier, who will give a presentation that will be followed by a debate. So feel free to ask your questions.
Pleasure to be here and have the opportunity to present my work here. So as was indicated, I would like to talk about the interaction between the different stability concepts. About financial stability, there's no financial crisis; price stability, that you want to avoid deflation or inflation; and fiscal debt sustainability, which essentially says that the government should be able to pay back its debt and should be sustainable in the long run. So traditionally, you have this three stability concept: financial stability, price stability, and debt sustainability. And before the crisis, it was thought you have essentially always one actor in charge of financial stability. Prudence policy and bank supervisors are in charge of financial stability. You have the central banks being in charge of price stability, and the fiscal policy actors, like the governments, they should be in charge of debt sustainability. So essentially you have along this diagonal, that's where this assignment of the task was assigned. What was ignored, that actually all these three measures interact quite a lot, and I would like to show you how they interact and what are the mechanisms how they interact, and what are the challenges then for the different players who have to coordinate then in order to avoid a worse outcome if they're compared to a situation when they don't coordinate. So in particular, what I want to focus on first is that there's some amplification mechanism going on within the financial sector. What do I mean by amplification mechanism? Amplification mechanism is there's a small shock, and then the small shock leads to a large implication. It's amplified and makes the whole thing much bigger. So a small initial trigger can lead to large dislocations. Typically, the way it works through liquidity spiral. If I look at the balance sheet of a bank, of a particular bank, banks typically have government bonds, they have some other assets, they also give some credit. And if there's a negative shock to any of these assets, they're cut back on how much credit they will give, and this also hurts then their funding position. It's much more difficult for them to fund positions, and there's actually leads to lower asset price again. So there will be this liquidity spiral. I will come back to this later again. Of course, it makes the balance sheet more risky, so the moneyness of the debt is going down. So banks also issue some money, so how they fund themselves is essentially through deposits, and deposits are a form of money, and we will come to this in a minute. What I want to do first, I want to show the interaction between financial stability and price stability. Traditionally, it was thought before the crisis, especially during the Great Moderation, where everybody thought everything is safe, that as long as you have a price stability secured, the financial sector will be sound and safe as well. We know now there are close interactions between the two stability concepts, and I want to show you one mechanism how it works. And typically, the way it works is that Whenever there's a crisis in the financial sector will shrink their balance sheets, so the total money supply in the economy is actually going down, and this leads to deflationary pressure. Then actually deflation increases the real value of the debt, which hurts the balance sheet again. That's the first mechanism we will walk through the slides. Later on, I will show the other mechanisms which lead to inflationary pressures, and you will see in times of crisis, deflationary pressures and inflationary pressures will be very powerful, and it's very difficult to keep the balance between the two forces. Okay, so let's first start with the interaction between financial stability and price stability through the Fisher deflation spiral. So essentially, to do this, let's just start with a simple economy, very stylized economy, and let's say there is only risky lending or direct lending. There's some end borrowers, some guys, some firms have some good idea, they want to produce something, and they want to raise some funds from some savers who have some excess funds. They want to save something. And the savers can buy some risky claims from these firms who produce something, or they can also hold some outside money. The outside money is given by the ECB. And as we will see, there are two types of money. There's outside money and there's inside money. What do I mean by that? Outside money is the money created by the central bank, by the ECB, for example. Inside money is the money created by the banking system inside the system. Okay, it's not coming from outside, it's not coming from the government, it's created by the banking system, like demand deposits. If you have some demand deposits in your checking account, in your bank, that's inside money. It's not created by the ECB, it's created by the banking system. So here I'm talking about a world without banks. I will introduce banks in a second step, where there's only outside money. You can only get, let's say, hold cash, which is issued by the ECB. So essentially, your choice here is, as a saver, if you're one of the savers, to lend some money to your friend. Your friend wants to buy a house or he wants to start a company, and that's quite risky because his company might not do so well, he might not pay back. That's one choice. And each of you guys, let's say you're the savers, you're the entrepreneurs, and each of you, one of you can actually lend some money to on the other side. Or the savers can also hold some outside money, and they can split it up the way they want to split it up. Now let me introduce banks. So we can also introduce banks or intermediaries who step in between. These are the intermediaries. Now the picture looks a little bit more difficult because we have also these banks floating around. So the banks, they can actually lend some money to these entrepreneurs. Remember, you're the entrepreneurs here, or the guys who want to buy a house, the end borrowers. And the banks hold risky claims now towards them, and they issue some inside money. That's the money, the demand deposits or any other debt issued by the intermediaries, which again is held by the savers. And the banks have also some net worth, i.e. some equity. So the balance sheet here on the asset side, they have claims towards the entrepreneurs. On the liability side, they have some inside money, demand deposits or other debt, and some equity. So there's some debt issue and there's some equity issue. Let's assume the equity is primarily held by the bankers themselves. Okay? So if you're a saver, what you can do, you can save inside money or outside money, which actually is the same, whether you hold cash or demand deposits. Or you can hold the risky claims directly, but essentially by holding inside money, you indirectly hold risky claims. You say, why do you go through this indirect channel and not just directly to the direct channel? Banks have some advantages direct lending doesn't have in this framework. To the bankers, for example, they can diversify across these end borrowers. So if there's some bankers, they can actually across these entrepreneurs, they can diversify, while you individually, you cannot diversify. You can't just hold a portfolio of all these investments. And secondly, the bankers might also be better in monitoring what's going on here in order to make sure the mortgage is paid back. Okay? They can go after you, they can enforce much better than individual households that the debtors are actually paying back their money. So these are the two advantages bankers have. So and this leads to more efficient lending if it's done through the banks rather than direct lending. Of course, if these borrowers are big corporations, they can also issue direct commercial paper, also corporate bonds, so that's less of an issue. But for smaller firms, it's way more efficient to go through the bank lending. And in Europe in particular, a lot of the lending is done through the banks. Now what I want to do is, so that's the framework. What I want to do is I want to shock the system. Now there's a negative shock because there's a subprime crisis in the US, and some of the bankers are exposed to it, or for other reasons there is a negative shock, and I want to split up this negative shock into 3 steps. Okay? Of course, in the framework, everything will occur simultaneously, but let me split it up into 3 little shocks, and then see how this whole thing feeds and amplifies. So the first shock is, there's some shock to the end borrowers. The firms are suddenly less productive, or some of these mortgages are not worth as much as you initially thought, because there are subprime mortgages in the United States, or other mortgages. House prices in Spain are going down. They're now more risky. So what you have is that these risky claims the bankers had, they're now worth less. So that's why I reduced the size of the box a little bit. Okay? Of course, the demand deposit of the bankers is not going down. It's still the same. So their liabilities is still the same. So everything has to be absorbed by the equity portion here. Okay, so the net worth or the equity portion of the bankers is going down. So you see they're highly levered. So any risk, a small 5% drop here will be much more drop here on the equity side. Let's suppose the equity halved here. It's roughly half as much as before. If nothing else happens in the system, if there's just a negative shock, then it just means that the bankers are twice as leveraged as before. What is leverage? Leverage is the size of this box relative to this box. How much is equity financed and how much is debt financed? So that's the first part of the shock. And if there's no behavioral response to that, that's it. Okay, nothing would happen. But what happens as a response of this, now the banks are much more levered, they're twice as much levered as before. They all try to shrink the balance sheet. Okay? How do they try to shrink the balance sheet? It's just they want to get rid of these risky claims. Okay? So everything is the same as before. Now they want to get rid of these risky claims in order to get the leverage back down to a level which is closer to the one before the shock occurred. Okay, so now they can sell it. The banks can sell the risky claims, these mortgage claims to each other, but this wouldn't change at all. But if they really want to fire sell to somebody, they have to sell it to the savers. Okay? But the savers are not so good in holding these claims because they cannot diversify and they can actually not monitor so well as the banks can. So the savers are not willing to pay much for these risky claims because in their eyes it's very, very risky. Okay, so the price of these risky claims is dropping. There's this fire sale, this liquidity spiral I was talking before, is amplifying the whole thing. So there's a huge amplification going on. Even if they sell a little bit, the price of these risky claims is going down quite a bit. And that's actually, amplifies and makes the whole thing even further, and more of the equity is eroded. Okay, that's the second step. Notice, by shrinking the balance sheet, they do also a second thing. The second thing is they also shrink the total size of the demand deposits. Okay? So on the liability side, the inside money is going down too. So what happens on top of it, the total size of outside money and inside money is actually going down. And this means if total money supply in the economy is going down, there's deflationary pressure. Okay? So there's deflation because now the value of goods is actually going up. So this deflationary pressure, so money is worth certainly more. So because of this deflation, the value of money is expanding. So you have this money box, the liabilities are expanding. And that hits the bankers again on the equity. The bank's equity is actually shrinking even further. So let me say this again. So the shrinkage of the balance sheet, because people are shrinking their balance sheets, so the total money supply is shrinking relative to outstanding goods. If nothing else were to change, there's deflationary pressure. The value of money is going up. But for banks, the value of money is on their liability. It's part of their liability, so their debt level is actually going up in real value. Okay? So that's why the net worth is actually shrinking even further. So these are that's a third effect. So you have first the initial shock Then you have these fire sales amplify this whole thing in the liquidity spiral on the asset side of the balance sheet. And then they try to shrink the balance sheet. By shrinking the balance sheet, they also shrink the total money supply, which leads to deflationary pressure, which hurts the banks again, when the equity is going down even further because debt is expanding. And the only way it can expand is just by eating further into equity. Okay? That's the third effect. And you can see already how the initial shock and the liquidity spiral and the response to shrink the balance sheets affects then price stability. In this case, it leads to deflationary pressure. Okay? So that's essentially summarized in this slide. What you have is, after the adverse shock, the intermediary's net worth, think of bank equity, is going down. They will try to fire sell some of these risky claims. The price of these risky claims will go down because you fire sell it to somebody who is not so good in holding these risky claims. Households cannot diversify or cannot monitor as well. So the allocative efficiency is actually going down. That's the liquidity spiral I was talking about beforehand. Now, on top of it, because they shrink the balance sheet, the lending is going down, and the number of deposits is going down because they shrink the balance sheet. Or instead of just holding them, just park the deposits in the ECB. That means the value of money is going up, or in other words, goods are getting cheaper. Deflation is kicking in. The money multiplier is actually shrinking. What do I mean by money multiplier? How much money is given from the central bank relative how much money is created by the banking system. The fraction of money which is created by the banking system is actually going down. Okay? So you saw in the crisis, you saw a collapse of the money multiplier across the world. Everywhere the money multiplier was collapsing. Less money was created by the banking system. It just came down. And this causes this deflationary pressure. First in the US, there was this deflationary pressure. And in Japan, it's already for 2 decades, this deflationary pressure going on here. Because of this, the real value of the liabilities of the banks are expanding. So the banks are hit on both sides of the balance sheet. The initial shock on the asset side, and then through deflation on the liability side. Assets shrink, liabilities expand. Both is bad for the banks. And all this risk is just triggered by a small initial shock. Because of this leverage in the banking system, it is amplified, so a small shock can amplify things. Risk is generated by the system endogenously. That's why it's often referred to as endogenous risk. It's generated by the system on its own. A small trigger can lead to large changes in the risk. Now, so that's essentially what's going on here, just drawing here again what we had before. There's this initial shock. It can be these other assets where there's some shock, and this leads to, if these banks were to raise new equity, all these things could be switched off. If you can force the banks, you lost on equity, instead of shrinking the balance sheet, raise new equity, issue new shares, then all this amplification is switched off. But if the banks refuse to issue new equity, which runs under the term financial dominance, then actually all this amplification is going on. So you have the money supply shrinking, as we had before, and this deflationary pressure. And of course, if money supply deflation is kicking in, the real value of the money is expanding, so you have this Fisher deflation spiral, and the situation is getting worse and worse. Now, what can monetary policy do, or what can one do? So as I mentioned already, one thing you can do is say to the banks, you issue new equity. You just have to issue new equity. You're not allowed to shrink your balance sheet. Our current regulatory framework is such that you have to have a certain minimum equity, but it's specified in percentages. You have to have at least 7% of equity relative to total assets. If you have 100 euros assets, you have to have 7 euros in equity. If you violate it, what can you do? 2 ways. You can either sell your assets, or you can issue new equity. So let's suppose you have 100 euros equity, total assets, but you have only 5 euros on equity. You can go out and issue new equity and raise another $2. Then you're fine again. Or you can say, okay, let me just sell some of these assets such that I have 7% of equity. There's a huge difference between the two things. From a bank's perspective, it's not so different. But from an economy-wide perspective, it's very different. The first approach, where you issue new equity, you don't have to fire sell any assets. In the second approach, you will fire sell assets, and this actually leads to this dislocation and this deflationary pressure I was talking about before. Of course, you can do something else. You can also just hand the bank as a bailout. You can say, oh, you're undercapitalized, there was this negative shock, now your equity is too low, I just give you some money as a present. Okay? And to some extent, you can redistribute wealth, and it might actually be good because you stimulate the economy, and the economy is going better. And one might argue that's what monetary policy does. Okay? To some extent, you redistribute wealth, so you figure out in the economy, here, for example, the banking sector, which sector is undercapitalized, is underwater, and suffers from a debt overhang problem. Like, if the banks suffer this negative shock, they will not give new loans, this will hurt the economy, so they suffer from a debt overhang problem. There's too much debt relative to the total assets. Now, how do you redistribute this wealth? One way you can do that is by saying the central bank is buying the assets this particular banking sector is holding. What are these assets? For example, long-term government bonds. If the banking sector is holding a lot of long-term government bonds and suffered a negative shock on something else, on mortgages, you just go out and buy long-term government bonds and cause a positive shock to offset the negative shock. Okay? That's one way how monetary policy works. What's monetary policy? Monetary policy, you change the interest rate, and you, through open market operations, you buy some government paper, long-term paper. If you cut the interest rate, the short-term interest rate, the value of a long-term bond is going up. Imagine a bond which pays 10 euros every month for the next 10 years. If the overall interest rate is dropping, the bond which pays off 10 euros every month in value is going up. Okay? So whenever the banking sector suffers some negative hit, and then it's amplified, and deflation kicks in and all this, what does the central bank do? The central bank cuts the interest rate and said, okay, now the banking sector has a positive shock which can offset the negative shock, and then we can switch off all this amplification which I talked about before. Okay? But essentially, it is a way to redistribute wealth from the non-banking sector to the banking sector. Okay? You can also do this through forced injection, to forced bailout in the banking sector. But that's how you could, for example, recapitalize, or that's how typically monetary policy works in a redistributional framework. Now you might say, that's really bad. It's like an insurance scheme for the banking sector. Whenever there's a positive shock, then we increase the interest rate, which means we lower the value of the government bonds. That's a negative shock, offsetting negative shock. Whenever there's a negative shock on mortgage paper, we lower the interest rate in order to create a positive shock on government papers. Okay? So that's like, monetary policy is essentially a big insurance scheme for the banking sector. And like any insurance scheme, this leads to something like moral hazard. What does moral hazard mean? It means that what you do, you don't bear the full risk because somebody else provides insurance, and then it distorts your behavior. You're willing to take on more risk because some of this risk will be offset if something goes wrong by the central bank. Okay? That's why you have to be very careful as central bank, and that's why you would like to have some measures which prevent the banking sector from taking so much risk. Okay? The banking sector naturally has the tendency to take on more risk because whenever something goes wrong, the banking sector knows the central bank has to cut interest rate and then essentially recapitalize the banking sector. And that's why we have all these macroprudential measures, that's the new heading under which they're running, that saying, You know, you can only take on so much risk. There has to be certain loan-to-value ratios. There had to be certain restrictions in order to make sure that the risk is contained. Now, that's essentially the old picture again. So that's essentially what I was just elaborating, the linkage between financial stability and price stability. If you have a negative shock, you have this Fiscal deflation spiral in the absence of any monetary policy reaction. So in the first step, what I told you with this balance sheets, essentially, there was no monetary policy reaction. It was just like under the gold standard. So there's just negative shock, and then this deflationary spiral. If the central bank can counteract this, they can switch off this deflationary pressure and then avoid this amplification of the initial shock. Remember, there's a small shock, then it's the liquidity spiral, the assets value drop much further, deflation spiral, liabilities are going up, both amplifies initial small shock to a dramatic, large, big shock. If the central bank can offset the small shock, negative shock, with a positive small shock, all this amplification is mitigated. It's much less dramatic. Now, let me add now debt sustainability. Let me add the fiscal authorities, the governments who decide about the budget. You know, how much debt should we have as a government? If I add this third dimension to it, how does the whole picture change? And that is, of course, what's often referred to as a game of chicken, where when there is a negative shock, there are losses, and the question is, who should bear these losses? And you can say the banks, or the equity holder, or even the bondholders of the bank should bear the losses. That's one outcome. Or, you know, the government can bear the losses, fiscal expenditures, or the central bank can bear the losses, and then essentially, which ultimately leads to high inflation. Okay? And I want to illustrate this diabolic loop between banking risk and the government risk. And there's a lot of talk in the Euro crisis about this diabolic loop. So now don't be scared about this picture. I put everything together. So we still have this old picture here. There's the liquidity spiral we had before. We have a Fiscal deflation spiral I was just explaining before. And now I add this diabolic loop, which is like this red dashed diabolic loop here. Okay? So let's go through the story again now with a banking sector and also with fiscal debt sustainability. What was the difference between what I was talking so far and what I will talk now? So far I was assuming there's no risk that the government is defaulting. So the possibility of a government default was zero. I relax now this assumption. I say, oh, it could be, if the government has too much debt, it could be that the government is defaulting. And how will this play out once I allow for this possibility? And that's when the diabolic loop is coming in. Okay, so again, there's this negative shock, let's say, to the other assets. There will be the fire sales and all this, and this causes this deflationary pressure and so forth. It also leads the banks not to give new loans, so the credit supply shrinks. The banker says, woof, I'm already so leveraged, I shouldn't give any new loans or new mortgages to households who want to buy a house or to some firms who want to start some investments. So credit supply shrinks. So because credit supply shrinks, GDP is shrinking, so total productivity in the economy is shrinking due to this credit crunch. And also, of course, the whole economy, there's much more uncertainty, so everybody withdraws on investment. So GDP is going down. As GDP is going down, the tax revenue is going down, and the banks are anyway in trouble, so the probability that you need a bank bailout is going up. Both is actually bad from a fiscal debt sustainability perspective. Okay? Now, there are three ways out. So one way out is, you know, the government is actually in a bad situation, is not well. It can, in the long run, it has to cut the expenditures. Okay, perhaps not immediately, because, you know, austerity might be counterproductive. In the long run, you want to bring the expenditure to GDP ratio in balance again. That's one thing. So if the central bank is in the driver's seat, if there's monetary dominance, and the central bank can impose on the fiscal authorities, you better bring your house in order, then that's one way to go. The other way to go is to say, okay, the monetary dominance, the central bank is not mitigating anything. The central bank is refusing to give in. But the fiscal authorities are also refusing to cut the expenditures. So if both of them are refusing to cut the expenditures, what's going on then? Then the likelihood that there will be a default on government debt is going up. Okay? The government is not cutting back on its expenditures. The inflation, the central bank is not allowing inflation. The third way out is default. There are losses in the system. It has to come through inflation. It has to come through lowering expenditures down the road or government default. So if there's possibility of default is going up, the value of the government bonds is actually going down, and the risk premium is going up. And this means because these bonds are held by the banks, the total value of the assets of the bankers is going down even further. Of course, this feeds again in this liquidity spiral, which feeds again in this Fisher deflation spiral. Okay? So if the central bank is not giving in, then you have this diabolic loop moving around here. And this, of course, amplifies further here and also amplifies further here. So you have about 3 diabolic loops which all feed on each other. You can see that a small shock can amplify to a much, much bigger shock down the road. Now you might say, okay, let's go for another scenario where there's fiscal dominance. So the fiscal authorities say, we don't cut any expenditures down the road, perhaps not right away, but even in the future we won't do it. And the monetary authority is very weak. Then their other outcome is inflation. And that's what I mean by this game of chicken. Game of chicken between fiscal authorities and the central monetary authorities or the central bank. Who is giving up? Who is blinking first? That's what's going on in Europe, the big time, across the world. The fiscal authorities, they don't want to absorb the losses. They want to say down the road, we want to cut expenditures. And on the other hand, the central banks don't want to say, oh, we allow for inflation to absorb the losses. So who is blinking first? Where is the compromise down the road? So when the fiscal dominance kicks in, then you will have high inflation, and then, of course, you have something which offsets this deflationary pressure. So at times of crisis, in normal times, you also have a little bit of deflationary pressure. You can also have a little bit of inflationary pressure. But in crisis times, the two forces become very powerful. You have one force pushing into deflation, and another force pushing into inflation. So both forces are very, very powerful, pushing in opposite direction. So what you have is that in times of crisis, to balance these two forces is very, very difficult. It's a huge challenge to balance these two forces. And the system is very unforgiving to small mistakes. If you make a small mistake or some certain bargaining is not working well, then the system drifts off to one extreme or in the other extreme. You might end up in a deflationary spiral and you have huge deflation and the whole economy destructs. Or you might also end up in a huge inflationary environment. Okay? And I compare it a little bit with the bicycle driver who drives on a bicycle. As long as the speed of the economy, the speed of the bicycle is fast enough, it's very easy to keep the balance between, left and right on the bicycle, between deflation and inflation. But when the speed of the economy slows down, becomes slower and slower, then you either drop off left or right. You might not know which way you will fall, but you know you might fall. Okay? And you can see this if you look at different inflation expectations. There's some guys in the marketplace who said, oh, we'll move into deflation. Really, things are getting worse. Debt overhang is getting much, much worse. Or others saying, oh, wow, we're moving back to Weimar in a high inflationary environment. And you can see this in the marketplace, in the inflation expectations, and the difference in the inflation expectations. So far I haven't said anything about a currency union. So far, this could have happened in any single country. Right? I just want to say, what is the complication once you have one central bank and multiple countries? Okay? So let me just spend a few minutes on that. So the first thing is, you have these capital flows across borders. And I will illustrate this in a minute. And instead of having this game of chicken between one central bank and one fiscal authority, you have now this game of chicken between one central bank and 17 fiscal authorities, or 17 governments, which makes the whole thing even more complicated, much more complicated. Who should absorb these losses? Which of these fiscal authorities? or the central bank. Let me first jump into the capital flows. And let me just give you a stylized picture how the run-up of the crisis works. And I just picked two countries, Spain and Germany. Being in Italy might be neutral to do that. And the way you can think of is the following schematic way. This flows before the crisis. There's a Spanish homeowner or Spanish builder. He wants to buy some elevator or some dishwasher. And I picked these numbers. You will see these examples in a minute. And there's some German firms who produce this elevators or dishwashers, which are then built into Spanish houses in Spain. And of course, the Spanish homeowner or builder finances, says it goes to his bank and says, okay, how should I fund this? Or you get a loan from us at a certain interest rate, which is a floating interest rate. So interest rate can go up and down depending how the market situations are changing. And part of this, the Spanish bank is funding it through the Spanish savers. But most of it, the Spanish bank is funding it through the interbank market. Says, oh, we need more funds in order to give the loans to our Spanish homeowners. We go to the interbank market, where the German financial institutions are essentially providing the funds. There's excess saving in Germany, and that gives it through the interbank market to the Spanish bank, and then the Spanish bank lends it on to the Spanish homeowner. And then there's, of course, the German saver who gives its deposits to the German bank passes on to the Spanish bank, and so forth. How does the payment for the dishwasher or the elevator is paid to this bank of the producer of this, and then, of course, then the wages are paid to the German saver, and that's how the whole situation works, and everything works fine for a long time, and more elevators and dishwashers are built. What's important is this is invested in some housing which is not very movable. Okay, housing is a collateral, but it's Spanish. Tearing out the dishwasher or the elevator is quite value destructive. Okay, destroys a lot of value. Now what happens is when the market breaks down, suddenly the interbank market doesn't work anymore. Then the Spanish bank, which funds to the Spanish homeowner has to pay every month a certain amount, and it says, whoa, the Spanish banks, we have no funding anymore. What should we do? We will charge a higher interest rate, and because it's short-term funding, short-term loan funding, then the Spanish banks, you have to pay to the Spaniard, you have to pay for your loan. The Spaniard said, oh, I can't anymore. What you can do is you can take out the dishwasher, or you can take out the elevator and fire sell the elevator essentially to the German saver. That's the only one you can sell it to. No bank wants to have this. So at the end, this physical good which served as collateral can be sold off to the German saver. But of course, the German saver is not willing to pay much for a used dishwasher, moving it back from Spain to Germany. So there's huge value destruction. You see how huge losses are coming up from this thing. So what's happening is that, oops, the interbank market breaks down. The ECB says, oh, this is just dramatic how the losses will come up there, how much value destruction there is in the system. The ECB jumps in and says, okay, instead of the interbank market, the German financial institutions can actually park their money with the ECB, and then the ECB is actually lending to the Spanish bank. Okay. So any risk now, which is, with this risky aspect here, the German banks don't bear this risk anymore. The risk is now borne with the ECB. So if this is really insolvent, then the losses go all to the ECB. Okay, that's like one in this game of chicken where the ECB is assuming these losses. This, then leads to inflationary pressure. Okay. Now, as I mentioned already, this game of chicken to the power of 17, essentially, you have, how can we solve this problem? So oh, the Spanish banks are risky, we have to recapitalize these banks. Okay. So the Spanish authorities have to go to the taxpayers and recapitalize their banks. Who is absorbing the losses? The Spaniards. Okay. Or we can say, we pass on the losses to the ECB. Who is absorbing the losses? The guys hold a lot of nominal claims. If you look at the survey, the Germans hold a lot of nominal claims. All their savings is in nominal claims. Most of the wealth in Italy and Spain is in real estate. There's not much nominal claims. In Germany, a lot of the wealth of the median household is in nominal claims. That's why the Germans are so risk-averse against high inflation, because all their savings is in money and not in real estate. Most are renting their houses. So that's one thing. Now, you can say you restructure the Spanish banks. You can wipe out the equity of the Spanish banks. This, of course, will hurt the Spanish equity holders, which are probably mostly Spaniards. You can also default on the Spanish banks. You just declare them as bankrupt. Then the German banks, which were lending to the Spanish banks, they lose what they were lending. So the German banks will suffer from that. Or if the ECB was already stepping in, it will be the ECB losing out on that. Okay? It depends how early you default. If you default very late, then it ends up in the ECB's hands. And you might also have to recapitalize then the German banks. So the German taxpayer is on the hook. Okay? And as I mentioned already before, the ECB refinances banks at a low rate, and then it's the case that, through high inflation, who is actually suffering from this the most? These are the guys who hold mostly nominal claims. So you have here, I just picked 2 countries here. Of course, there are 17 countries. You can see if you go for these options, it is mostly at the expense of Spaniards. If you go for one of these options, it's mostly at the expense of Germans. Okay? And what's going on in the euro crisis is that everybody says, wait a minute, perhaps there's some hope, perhaps the situation improves again, and then there are no losses. And then, we can grow out of these losses, or there's a chance that somebody else will absorb the losses. So the Germans are waiting for the Spaniards to absorb the losses. The Spaniards are waiting for the Germans to absorb the losses. And at the end, more and more of these dishwashers have to be taken out of these houses and fire sold to the Germans. And the losses accumulate in the system. Okay? So I'm doing with time. 5 minutes. Okay. So that's what's going on essentially. So you have this huge problem in the system, and you have these capital flows which initially build up, and this capital flow is very, these are all houses or some durable goods which are not easily resold, or if you fire sell them, they will only be sold at a huge discount. The other element you have is that you have a lot of capital flows back to Germany. So in the olden days, all this capital through the banking system was going out of Germany into Spain. Now everybody is scared that this is becoming more and more risky because of this amplification. Everybody wants to bring the funds back to a safe haven. So there's a lot of shift back of capital flow back to Germany to flight to safety. Okay? So you have more and more flight to safety going on. So what happens is today that the value of German debt is increasing, and that's the case, it's even increasing even though Germany is getting less safe. But what matters is relative safety. So if you look at something like CDS spreads, which are insurance products to insure against the default of Germany, it's also more expensive to insure yourself against the default of German debt, because Germany is getting more risky as well, because Germany is assuming all this liabilities through Target 2 and other measures. So if whenever the crisis gets more dramatic, then you have the value of the Italian or Spanish debt is going down, the spreads are widening, and for German spread is actually, the interest rate is going down. So the Italian and the Spanish interest is going up, interest rate is going up, and the German interest rate is going down. Now, how can you solve this problem that you have this flight to safety across borders? Okay, is there a way to redesign the system that you don't have this flight to safety across borders? So you have, funds flowing out of Spain into Germany when the situation, first it was flowing the opposite direction and then it flows back. Can we redesign the system in such a way that we don't have this across the border flight to safety? So one thing is, what was often debated is the Eurobond. Let's just make all the bonds the same. And if something goes wrong in Spain, the Germans have to pay for it as well. So essentially, there's no Spanish bond anymore, there's no German bond anymore, and there's essentially only the euro bond, so they're all treated the same. There's no reason to have any flight to safety anymore. Okay. But of course, it also distorts incentives. You might go into higher debt level, knowing that the other country has to pay for it. And that's, of course, hugely problematic from a German perspective. Another way of doing this is what Luis Garicano and others will propose through so-called European safe bonds, or SBs. And the idea is the following. You have a European debt agency which buys up a fraction of the Spanish bonds, a fraction of the Italian bonds, a fraction of the German bonds, and so forth, all together, and pools it together on the asset side of this balance sheet of the European debt agency. And then it issues two bonds, a senior bond and a junior bond. Okay? So the senior bond is here and the junior bond is here. What's the difference? If there are losses on this side, the junior bond is hit first and protects the senior bond. Okay? And notice, there's a negative correlation on the asset side. Whenever the crisis becomes more severe, the value of the German bond is going up, the value of the Spanish bond is going down. So they always move in the opposite direction. So there's very good diversification on the asset side. Okay? There's negative correlation among these bonds, which again protects the senior bond here. Now, instead of having this capital flows across borders, you will now have the capital flows across the junior bond to the senior bond. So instead of having flight to safety from Spain or Italy into Germany, when the crisis gets worse, or in the opposite direction when the crisis resumes, now you have flight to safety from the junior tranche or junior bond to the senior bond. Both are European bonds. Okay, so here from one European entity, like a junior European bond, to a senior European bond, and there's no flight to safety across borders anymore. So you redirect the flight to safety across borders from some European unit to another European bond unit. So this way, you redirect this flight to safety and you stabilize, you bring the yields down in these peripheral countries, and of course it will also move up the yields of the German bonds to some extent. It just will equalize it, but this is done without any joint liability. It's never the case that Germany will be liable for Spanish debt or for Italian debt. So it's way more easy to push through the German Constitutional Court. It's just through a bond structure where you just redirect the flight to safety capital flows. So let me just conclude, and I tried to squeeze a lot of material into this short presentation. What I wanted to convey here is two things. First, all these three stability concepts, financial stability to avoid a financial crisis, inflation/deflation risk is highly interlinked, and is also highly interlinked with fiscal debt sustainability. These are three separate stability concepts which initially economists thought can be treated separately through three different agencies, but we can't separate these tasks so nicely, and these agencies have to work closely together to do that. Monetary policy can help to avoid this deflationary spiral, and the way it works is it essentially recapitalizes banks in times of crisis. We call it a stealth recapitalization. It's a sneaky way of recapitalizing banks. You cut the interest rate, and by cutting the interest rate, you increase the value of the long-term bond they're holding on the asset side. There's a negative shock on mortgages, you cut the interest rate, and this cutting the interest rate leads to a positive shock on government paper, and so the negative shock is partially offset by a positive shock on government paper. And this helps. There's a game of chicken going on. Once there are losses in the system, if there are no losses in the system, if it's purely a liquidity problem, fine. A multiple equilibrium problem is a liquidity problem, then we can solve for it, the central bank can just solve it. But if there are losses in the system, then a game of chicken starts. Who is absorbing the losses? There's 17 fiscal authorities, and there's one central bank. Who will absorb the losses? And the longer you delay this decision, who will absorb the losses, the more the losses will accumulate. the more losses will arise in the system. But of course, everybody is trying to push the losses on somebody else, and that makes the losses bigger and bigger. Now nobody wants to resolve the problem up front. And as I mentioned, this leads to the strategic delays and makes things worse. And then I mentioned finally this European Safe Bond, which allows and rechannels the flight to safety from the southern countries to Germany to have, instead of having flight to safety across borders, you have it across the junior bond to the senior bond, and both bonds are European bonds. So it's from one European unit to another European unit. So let me leave it at that, and I think we can go to the Q&A part. Thank you.
Sì, grazie. Domande, professor Brunnermeier, ce ne sono.
Well, probably there are many questions, Professor Brunnermeier. I would have many questions to ask myself. Perhaps we could collect a few questions and then I'm going to give you the floor back.
Due o tre vorrei porgliele subito io. Se non ritenga.
Don't you think that this game of chicken that you referred to us about and that you presented with great detail, don't you think that this game of chicken is somehow urging or pushing towards the de facto change of the role of the European Central Bank? Don't you think that the role is changing because of this game of chicken? During this major crisis affecting sovereign debt in Europe, the European Central Bank has changed its mission. It used to be somehow the guardian on the stability of price and controlling liquidity on the market, and now the new role for the ECB is that of a lender of last resort. The second question that I'd like to put is the following, and that has to do with a new net worth requirements for the European Bank because of the Basel III agreements. Do you think that these new requirements for banks may have repercussions, may have a negative impact on the financial stability, as probably is one of the risks that we run in that? And then the third is more of a political question. You talked to us about this possibility to have either Eurobond or stability bond or ESBs or whatever we call them. Don't you think that after the elections in Germany to be held on September next, don't you think that there's going to be a further acceleration in terms of decision-making towards this direction? These are the three questions that I have myself. And then probably we're going to take a few questions from the floor if there are any. So the discussion is open to questions from the floor. My name is Giovanna Bonfini. I have a question. As a matter of fact, I have a couple of questions. One has to do with Giacinto Auriti, an Italian economist who died recently, and I'm a strong supporter of his ideas. He was raising one question: who does the euro belong to? Who does the euro belong to? Because we might pay people in Naples to print false money, and that would cost much less. The euro, as minted by the ECB, costs much more than the money printed by forgers in Naples. I believe that you know the John Perkins writing The Confessions of a Killer. There's a very nice documentary that was shot by somebody from South Tyrol together with another young man from Austria, talking about the Brussels business. So who does Europe belong to? Who does this union belong to? Because it seems that there are international lobbies in it that are exercising pressure on the European market. So Don't you think that John Perkins is right in that we are blackmailed by international lobbies, which is to affect the European market, and more specifically, there are lobbies coming from the US that negatively impact the European market?
Si è parlato di loop diabolico, ne ha parlato anche Garicano nella sua presentazione di 2 giorni fa.
You spoke of the diabolic loop. How can we break this loop that brings banks to become indebted with sovereign states, and sovereign states have a huge debt? I mean, how can we break this vicious circle? Another question? This was exactly what the professor has just tried to explain to us. So this is my question. As an alternative to Eurobonds, do you believe that we could have the European Central Bank to buy on the secondary market? They could announce a program to buy the bonds of all Euroland governments, at least 60% in 10 years, 500 billion per year. And in this way, we could break the diabolic loop that you mentioned. And this can be done immediately. And all southern countries, after all, have agreed with the fiscal compact. So nobody fears Germany any longer. Well, we have collected a total of 6 questions, so I believe we should leave the floor to our speaker for the answers, and then we can see perhaps if there are any other questions.
Okay, thanks a lot for the questions. So let me start with the game of chicken. Is the role of the ECB changing? And I think it is changing, and the ECB is, of course, very well aware of the problems that everybody tries to push the losses onto the ECB's balance sheet. And at the end, the ECB will hold the bag. And that's why we have OMT. I mean, the conditionality Draghi tries to impose on the governments, so the ECB cannot absorb the losses without fundamental changes in the expenditure structure down the road. If the ECB were to buy bonds directly without any limit and without conditionality, then the governments would have no incentive to change the expenditure structure down the road or to take measures which boost GDP growth down the road, and then the ECB would be in deep trouble, suffering losses, and essentially the only way out is through high inflation, generate income through higher inflation. And inflation expectations will pick up. And the ECB is very worried about that, and rightly so. The second question was about the Basel III requirement. Yes, there are new requirements. There's a phase where you can phase in these new requirements. The big problem with the requirements, as I mentioned before, is essentially they are all in percentage terms rather than euro level terms. So how you can satisfy these requirements, you can shrink the balance sheet, and by shrinking the balance sheets and by not giving new credit, you make the situation even worse. Because you don't give to small and medium enterprises any new money, new loans, and the economy can't grow anymore. And this, of course, makes the existing loans more risky, and it makes the whole situation even worse, and the diabolic loop kicks in on top of that. So what you really want is, you would like to have some requirements which are based on euros, which force the banks to issue new equity. Like Deutsche Bank was just issuing 3 billion euros, so they have to be forced to issue new equity rather than to fire sell existing assets, rather than stop lending on the small companies. They have to issue new loss absorbing capital. So the third question was about SPs. About politics. Yeah, so it's, of course, you have to, that's where the lobbying aspect comes in too. Of course, by issuing new equity, you dilute the existing shareholders. Now, they don't like that. They like to have this upside option value, and by issuing new equity, the existing share price will go down. And of course, there's huge lobbying pressure that you don't go down the road. But the question is, what is good for society and what is good for the shareholders of banks? And you have to push essentially what's good for society, and you have to force them to issue new equity. And at the moment, we don't have the legal framework to really enforce that, and that has to change. Whom does the euro belong to? The euro belongs to the citizens. It's definitely, I mean, it's European money, and it should belong to the citizens. But of course, it is fiat money, it is an abstract concept, and one has to design it well such that it's not ruled by the power of certain lobbyists. And that's where you have to see where the connection between the banking system and price stability comes. If you treat price stability totally divorced from the banking system, as we have done beforehand, you don't see that, you know, you need some strict bank regulation and enforce, let's say, issuance of new equity in order to have a stable euro which belongs to the average citizens. And it is essentially the poor who save in terms of nominal claims. That's why you have to guard against being this, the value of either deflation, which is bad, which makes the whole system worse, or also high inflation. In both scenarios, you have to make sure that this is not going out of hand. How do you break the diabolic loop? Again, to break the diabolic loop, there is two ways you can break it. One is you don't want to have this risk of a sovereign default on the balance sheet of banks. Okay, there's no reason why this should be the case. Ideally, this risk should be spread out across many, many households. If there's a risk of default, it's fine. Greece, for example, there was a default on Greek debt. It is very small relative to the European-sized economy. If everybody of you were holding a little bit of Greek debt and then there were to be a default, you wouldn't hardly notice it. But because this debt is held by highly levered banks, it's amplified, and then a small shock is translated in a much, much bigger shock and much huge real amplification and the real economy. And you have to minimize that. Think about this, how it's done in the US. Think about the municipal bond market in the US. There's a lot of states and municipalities, townships, who issue a lot of bonds in the United States. These bonds are not held by the banks, they're held by individual households in the pension funds and so forth. If one municipality or one state goes under, defaults on it, it doesn't amplify because it's not held by these highly levered banks. So you have to push essentially the risk of sovereign default out of the balance sheet of the banks. And in one way, this SB's proposal, that's one reason why we propose that, because the senior bond is very safe. The junior bond is risky. The junior bond should be held by individual households. You get a much higher return, it's more risky, but it has to be spread widely across many, many households and should not be held by highly levered institutions. Highly levered institutions which then get a government guarantee and also are recapitalized through monetary policy, they should hold some safe bonds. They should not hold, and they should lend to the real economy, but they should not assume sovereign debt risk. So how do you solve it? Either you have recapitalized the banks much more. Right now, the system is very inconsistent. If you hold some risky sovereign debt, you get a zero risk weight. On the one hand, we treat sovereign debt as risk-free. On the other hand, we have the no bailout clause saying, okay, essentially we have to let some sovereigns default. It's very inconsistent. Okay, so either you have to go in one way or the other way, but if you go the way you want some defaults like the US system on municipalities, then you have to make sure it's not held highly levered by institutions. Concerning second market purchase programs by the ECB, why doesn't the ECB just buy up all the government debt? Then that's exactly where the game of chicken comes. If something goes wrong, the ECB is holding on all the losses. If certain debt levels are not sustainable, somebody has to cut back the expenditure or has to reform the economy to stimulate growth. And if this doesn't happen, only the fiscal authorities can do that. Monetary policy can just buy time and can make sure the framework is given that everything is fine. But the fiscal authorities have to say, okay, we have to restructure the economy, we have to change the laws, and we have to do that. And if the fiscal authority refuses this, and just wants to issue more and more debt, and then the ECB is buying it, then the ECB ends up with all the losses down the road. And the ECB has no choice than to let high inflation rule Euroland. And that's essentially the dilemma the ECB stands. That's why, again, with the OMT measures, it imposes a conditionality, saying, okay, we only buy it once you join and become a program country, and once you sign up for all these fiscal measures, which should ensure down the road the fiscal debt level is sustainable.
Io, professore, avrei un'altra questione che mi piacerebbe.
Professor Brunnermeier, I have another question on Italy. We were talking about fiscal consolidation efforts. Well, our country made a major effort in 2011. Governor Fiscal just recalled it. A very harsh action was taken, 4 points of our GDP, so much so that our country closed the year with a deficit at 12%. And as a matter of fact, Italy is not in a procedure for negative behavior. So what do you think about the sustainability of Italian public finance in the medium term? And do you think that there's any room, there's any flexibility that Italy can use with the European Commission, especially when it comes to public investments? Do you think there's room for maneuver there? Do you think that by means of the co-financing procedure, Italy can start some kind of mini golden rule? Let's see whether there are more questions, and I believe that we take just one more question. I don't understand this question, says the chair. There's room for one more question. Well, first of all, I'd like to thank Professor Brunnermeier for this very rich lecture. Secondly, I have a couple of questions. One has to do with the European bonds. Well, the ESBs seem actually a very interesting proposal. Can you expand a bit on the way they work, the ESBs? I don't know whether I have more time. Well, we have 10 minutes altogether, so we have to give back the floor to Professor Brunnermeier because time is nearly up. So can you expand a bit on how they operate, how these European safe bonds should operate? What kind of bonds would they have to do with? Would they going to be new issue? Would they be on the secondary market? And would that do away with any problem of moral hazard that is indeed the main reason why those that why many people criticize Eurobonds? Then I'd like to refer to our common fiscal policy. What do you think about having one single fiscal policy? Do you think there's a strong will politically to follow the example of the U.S. with some kind of a fiscal federalism, as American economists had proposed some 10 years ago? Or do you think that we shall remain in a very fragile situation, so very characterized by fragmentation? Thank you very much, actually. We would need another additional lecture to take all your questions. This is going to be the very last question. Professor Brunnermeier, what do you think about the European legislative reaction to the problem that you refer to as, for example, crisis management, Basel III with single banking supervision? How do you think that the reaction from the European Union was? This is really going to be the last. During these days, I heard that different people stated that the crisis originated from an excess in leveraged or indebtedness or too high debt. So my question would be as follows. What would be the break-even point we should aim at to be in a stability? Do we have to cut on debt? Because as a matter of fact, what you apparently ask for is increasing debt. Obviously, we have disparities and differences in different countries, and the balance between public and private debt is different in different countries. But I believe that, again, apparently finance has grown enormously, and perhaps we should curb this abnormal growth of finance. I think that we should try and generate more wealth rather than more debts.
Last question. So how much debt is sustainable? That depends very much what the growth prospects of a country are and what potential demographics and many things play in. I totally agree with you that we should actually aim for a lower leverage ratio, and we might be able to do it with a smarter design. We would like to have more equity issuance rather than debt issuance. We would like to have debt which is indexed on the growth of a country. So whenever there's a negative surprise shock, it is absorbed and distributed wisely. So the risk is distributed widely across many players or many savers in the economy. Again, the problem comes from leverage, because leverage leads to concentration of risk to few players in the economy, and then it amplifies the whole thing. So if you can design them bonds which are indexed to GDP growth or some other things which are more equity-like and less debt structures or instruments, I think you can spread the risk more easily and you avoid the amplification and the negative impacts on the real economy. So let me come back to the Italian questions. So there are two components to it. So should you cut back on expenditures right away? So I think it's very important to have some structural reforms. So no, I'm not a guy who says, okay, you have to cut back your expenditures here and there and just satisfy a certain ratio. I think what you would like to do is to change the structure, make the economy more efficient, change your labor laws or any other laws you have, make it easier for people to start a company and all this. And it might be that down the road, but not right now in the recession, you cut back on the expenditures. Okay? And you might raise some new tax revenue. So there might be a nice transition path where I say you have to commit. The problem is for governments that they can always say, you know, in 3 years we will increase our taxes once we're out of the crisis, but then they change their mind. They can't really believably, credibly commit to such a strategy, and that's a big problem. But if there is a way to commit to this, I think that's the way to go. Now, what happens is, of course, there's also often multiple equilibrium scenario. What do I mean by that? If the market believes that Italy will do well, will reduce its debt, will actually have a lower expenditure ratio and GDP growth will come back, they will lend to you at a lower rate. And because they lend to you at a lower rate, you can also find the transition and find your way to get there. Okay? If the market, so that's one equilibrium, it's one coherent scenario where the whole thing we might end up with, and that's a good scenario. Of course, there's another scenario which is also very consistent. The market doesn't believe that the government down the road will do the right measures or will not restructure the right way to make the economy more efficient, give the young people more chances. So there's an intergenerational big problem in Italy that gives the young people more chances to find jobs, build up human capital, and be productive down the road. And if the market believes this will not happen, and down the road the GDP growth is not coming and expenditures will not be cut down the road, where taxes revenue will be high enough, but then they will charge a high interest rate because they say our lending is more and more risky. And because they charge such a high interest rate, the government will not be able to implement these reforms. Okay? That's a bad scenario. So the aim is essentially to credibly communicate to the marketplace that these measures are coming, and there needs to be a certain trust between the market participants and the governments to generate and stay in this good scenario, in the good equilibrium. How will the SPs work? Let me move to the second question. Yeah, I could talk, I mean, we have, a long document on this, how the details work. So what we have in mind is that the SPs is essentially a structure where there's no common and joint liability structure. It's essentially, there will be a European debt agency. The European debt agency is buying part of their sovereign debt. Let's make a case of Italy. Italy is issuing some debt. It has about 120 or 130% of GDP in that level. And this European debt agency would buy up 60% of GDP, roughly half of the new issuance. So whenever Italy issues a new debt, half of it is bought up by this European debt agency. The other half is still free floating in the market. Hence, there is a market price. At this market price, the European debt agency is also buying up the Italian debt. Okay, of course, there is some demand pressure coming from the European debt agency because it assumes half of the debt. This controls the moral hazard aspect. If now the Italian government should do something crazy, which is not sustainable down the road, for the other half, you have to pay a high interest rate because the market participants will be scared and will charge a high interest rate. And this European debt agency will also only buy at this high interest rate. Okay, so the moral hazard aspect is under control through the interest rate. And there are many issues in terms of also have to decide, what maturity to issue. If Italy is issuing certain debt, is it a 3-year, 5-year, 10-year bond? Of course, then the SPs has to be accordingly, also 3-year, 5-year, 10-year, and the national debt agencies have to issue at the same time in order to have this coordinated, then bought up by the European debt agency and then issued with the same maturity. And all these things, we can talk about this, but there are many details which we have to work out. What about common fiscal policy? I think all what we need is a common fiscal responsibility framework where people behave responsibly and find a way that we don't end up recurrently in a crisis. So we're in a certain crisis situation now. There's surely a willingness to get out of it, but one has to find a framework that we don't end up in a crisis over and over again. That's the key, and we have to find the right setup where this will not occur over and over again. So essentially there are two ways to control that. One is through market discipline, and one is through an institutional arrangement. So there will be some European authority which says, okay, that's how much debt you can make. It has to be sustainable. That's what the fiscal compact is for. That's one pillar. The other pillar is essentially market discipline. We say, okay, if you don't behave, the interest rate is going up, and we need the market discipline. If you introduce a Eurobond, the market discipline is not there anymore. And that's the question. That's where the divide is. Certain people say we don't need the market discipline. Other people say markets, we don't need it because it's not reliable anyway. We have seen it. So, only in crisis time suddenly the interest rate shoots up. Others say no, we need the market discipline. At the end of the day, it's only the market discipline which really works. These politicians, they can agree to anything, and at the end, it doesn't bite because they get out of it. Germany and France, essentially, when the Stability and Growth Pact was biting them, they just agreed to get out of it. So politicians always find a way around it. So the institutional arrangement is not really working either. I think probably you need both, and you have to be aware that both pillars might fail, okay, as they did last time around. But just giving up one pillar and just relying on the other one alone, I think is probably too risky. And again, we have to have some common rules within the fiscal units we can call it sharing of sovereignty. It's just make sure that we don't end up in a crisis scenario over and over again. Finally, European legislation concerning Basel III, single supervision authority. I think it's important. Right now, it is the case that national bank supervision was very much done at the national level, and there was no information sharing across national supervisor, or very limited information sharing across supervisor. So if a bank is in trouble in some country, other supervisors would have no ideas about it. And in particular, the ECB would have no ideas. And at the end, the ECB is asked, help out. We are actually a solvent bank, and the ECB doesn't know what's going on. I mean, is this bank solvent? Is it not solvent? What assets are on the books? Or what, are these impaired assets, assets which are not worth much anymore, toxic assets? And they have no idea what's going on. So now with the single supervisory structure, the ECB has the power to go into the books of these banks and figure out which banks are zombie banks and which banks are reliable banks and should get funding. At the end, the role of a central bank is to provide liquidity support to solvent banks. It is not the role of a central bank to help out insolvent banks and just make zombie banks out of them. And it is the case that in certain countries, the banking structure is just overblown. There was huge housing booms in certain countries. The banking sector is too big, and the banking sector has to shrink. It has to shrink in the United States too. And that's the reality. There's no way around it. If one sector is too big, it has to come back to a regular size. And that's essentially through the single supervisory framework you can achieve that. What's also needed is a restructuring mechanism. So you don't want that the bank has to really go into bankruptcy all the way down the road, cause a lot of spillovers, and then destroy large fractions of the economy. What you really want is that you can actually close down the bank just before it is insolvent. Like there's so-called prompt corrective action, which, like in the US, what's going on is that if a bank is very close to insolvency, it will be closed on Friday afternoon. On Monday morning, it is opened under a different name and a different management and potentially merged with some other bank. And the shareholders are wiped out and potential bondholders are wiped out too. We have to find a legal framework which is the same across Europe, where authorities can move in and close down these banks and reopen it on Monday, such that the demand depositors don't suffer anything. Of course, somebody has to bear the losses, the shareholders and some senior bondholders have to bear the losses, but we need some resolution authority which can do that. So let me leave it at that.
Sì, grazie. Io ne ringrazio.
Thank you very much, Professor Brunnermeier. Thank you very much to all of you for this most interesting Q&A time. I learned quite a lot. Thank you very much. I really learned a lot. I hope I can meet you again here in Trento next year. And it would be nice to talk not just about the effect of austerity or about how to tackle existing systemic crisis, but in the case Europe starts on the right path, supporting growth, supporting employment. It would be nice to talk about that as it could happen after the summit next June. So I hope to meet you again next year. Thank you very much to you all.
Thank you.